Welcome to Finance Dojo. We aim to be the best personal finance educational channel you'll ever need. Click that subscribe button and the notification bell right now so you won't miss out. One of the most common concerns of people aiming for financial independence is the chance that their assets would underperform once they retire, resulting in a lack of funds. People have taken a variety of ways to retire on dividends alone. To live off dividends without having to sell any of their investments, there are three primary methods that people use to do so. The first is to put money into ETFs or mutual funds, tracking high-yield dividend stocks. The second is known as dividend growth investing. And the third is to just invest in a company or fund that produces normal dividends. Each of these methods has its own advantages and disadvantages. High-yielding dividend stocks may be thrilling and rewarding, but they can also be quite dangerous if you don't have enough knowledge. The advantage of this strategy is the amount of money you may make, even with a very little investment. There are different ways to invest in high-yield dividend area, including buying individual firms that pay a high yield, or buying mutual funds and ETFs that pull a number of these sorts of companies, resulting in a yield that is greater than the average for most funds. Of course, riskier to invest in individual firms, but the potential benefits are enormous. Some of the highest dividend-paying equities have yields that are in the double digits as of early June 2021. USA Compression Partners, ICANN Enterprises, Not Offshore Partners, and Natural Health Trends Corporation are just a few examples of companies with significant stakes above 13%. Even if the stock prices of these firms don't rise, double-digit returns are still a terrific deal. Imagine if you were able to retire rapidly if you were able to invest in these firms and get those kinds of rates. The reason for this is that your safe withdrawal rate would be in the double digits. Using ICANN Enterprises' 14.5% dividend yield as an example, a retirement budget of $50,000 a year would only require a nest egg of $345,000, and it may even be less than that. Consider the conventional 4% rule, which indicates that you need a nest egg worth about 25 times your yearly cost in retirement to be considered financially independent. To put it another way, you'd need around $1.25 million to meet your $50,000 annual cost. Hence, you may appreciate the significance here. The disadvantage of this strategy is that it's extremely rare for a company to be able to maintain such a high level of dividend payout for an extended period. And if the company announces that it will be lowering or eliminating its dividend, the stock price can plummet quickly. This is because most investors in these extremely high-yield companies aren't investing in the company because they think it's good. They're investing in it for more income. When income returns to a more normal or near normal level, the risk-reward trade-off shifts, which frequently results in a sell-off. For this approach to work to its full potential, an investor must be willing to jump into and out of investment on a regular basis. If you're searching for a high-yield approach, you don't have to invest in specific companies any longer. Many investors just buy high-yield dividend mutual funds or exchange-traded funds or ETF. You won't get quite the same spectacular yields, but you'll be much more diversified than you would have been if you pick a few specific companies with such sky-high yields. The Spider High Yield Dividend ETF and Vanguard's High Yield Dividend ETF are two examples of high-yield dividend funds. The Spider Fund has a 4.66% yield, while the Vanguard Fund has 2.82% yield as of this writing. Granted, there is a significant drop in yield from the highest yielding individual equities. They do provide some share price growth and both outperform a pure S&P 500 index fund in terms of yield. Vanguard's S&P 500 ETF offers a yield of slightly under 1.4% right now. The second alternative is to invest in investments that have a track record of consistently providing and increasing dividends. This is known as dividend growth investing because the dividends you get rise over time. It can be quite profitable if you stick with it. As with a high-yield dividend strategy, You can invest in individual firms that match the requirements or in funds that combine several of them. Individually investing in the companies can still be dangerous, but it's not as risky as investing in those particular high-yield companies. The reason for this is that firms that qualify as great dividend growth investments are typically well-established businesses that have demonstrated their capacity to maintain or even increase their regular payout over time. Dividend growth investments are typically divided into many categories based on the size of the firm, the liquidity of the stock, and the length of the time the company has been paying dividends. Although some individuals describe things differently, the most frequent classification is challengers, achievers, champions, aristocrats, or kings. Dividend challengers are stocks that have increased their dividends for at least 5 years in a row. Dividend achievers have paid increasing dividends for at least 10 years in a row. Dividend champions have had a 25-year winning streak. Dividend aristocrats have a 25-year or longer dividend history, but they must also meet specific size and liquidity standards. Dividend kings are an even more limited group of companies that have paid an increasing dividend for at least 50 years. The most well-known classification is dividend aristocrats, which is also the one that has an index fund that tracks it in the form of ProShares Noble Fund. The main benefits of using this approach to retire on dividends alone are that of your dividend payout generally increases over time without requiring you to invest in a bunch of troubled companies or fly-by-night stocks that can be extremely volatile during market turbulence. Also, respectable levels of income combined with acceptable levels of volatility is a pretty good combination for a retiree. The downside of this strategy are that it does not always provide the same level of share price growth as other strategies, and it normally does not have as high a potential income ceiling as a high-yield strategy, simply because the yields are smaller. The third alternative isn't particularly lucrative in terms of dividends, but it's something that some people choose to do to reap its other benefits while planning to retire on dividends alone. You can simply invest in a broad-based market index fund that pays dividends, such as the S&P 500. The pros are that there is generally more upside to the appreciation potential of something like the S&P 500 than there is for already well-established dividend growth investments and or those higher risk. Higher yield dividend stocks whose potentially high reward is usually in the form of dividends rather than share price appreciation. This could imply that the value of your savings grows faster than it would with a high-yield fund or a dividend growth strategy. Though depending on the time frame you're looking at, the higher dividend income from those other options, if reinvested, may be enough to cover the appreciation gap. The disadvantage for most people who plan to retire solely on dividend income is that they'll need a lot more money in their nest egg to achieve their objective than with either of the two options. When we compare the dividend yields of these three strategies, we find that the Spider High Yield Fund has a dividend yield of roughly 4.66%. The S&P 500 is around 1.40%, while the ProShares Dividend Growth Fund is around 1.93%. That indicates that to satisfy your expenses on a $50,000 income objective, you'd need about $1.073 million in the high-yield fund. To be considered financially independent based solely on dividend income, you'll need $2.59 million with the Dividend Growth Fund and $3.571 million with the S&P 500. Now, directly comparing these approaches can be difficult because there are so many moving parts, such as companies joining and leaving dividend growth lists like the aristocrats. To get a sense of how these techniques have done throughout the years, I compared them to several Vanguard funds. I utilized Vanguard's High Yield Index ETF for the High Yield Dividend Fund. I utilized Vanguard's Dividend Appreciation Index for the Dividend Growth Fund and Vanguard's Original Index Fund for the S&P 500. Because they have been around as long as ProShares Noble Fund and Vanguard's S&P 500 ETF, I didn't use them. The Noble Fund was established in 2013, while Vanguard's VO ETF was established in 2010. The High Yield Dividend Fund was established in late 2006, and the period we'll be looking at is from late 2006 to May 2021. This means we'll be able to see how these strategies performed during the Great Recession of 2007 to 2008, the Great Bull Run of the 2010s, and the most recent downturn in 2020. During this period, the S&P 500 strategy had the best overall growth of the three funds, with an average return of roughly 10% every year. By mid-2021, a $1 million portfolio in late 2006 would have risen to roughly $3.96 million. Of course, the largest crash came during the Great Recession, when the stock price plummeted by roughly 52.4% at its worst. According to Yahoo Finance, it declined by nearly 20% during the 2020 crisis. Throughout this roughly 14.5-year period, that $1 million original nest fund would have earned nearly $443,000 in dividends. That works out to around $30,300 each year, or $263 per month on average. The dividend growth strategy is second in terms of overall returns. During this time, it averaged 9.7% annual returns, implying that a $1 million portfolio would have grown to roughly $3.87 million in mid-2020. During these years, it also managed to develop better crash stats. During the Great Recession, it plummeted by only 42.7% or 41% when dividends are taken into account, and recovered by February 2011. According to Yahoo Finance monthly return data, the S&P 500 didn't fully recover until approximately March 2012, and then it plunged by roughly 17% in 2020. Its dividends also managed to give greater income than the S&P 500 method during these years. During this 14.5-year period, a $1 million original portfolio would have yielded roughly $494,500 in dividend income. On average, that works out to about $34,000 each year, or $2,825 every month. The high-yield approach came in third in terms of total returns and stability during these years, with average annualized returns of roughly 8.4% each year and a 54.4% drop during the Great Recession, with dividends falling by 51.6%. It also plummeted about 24% during the 2020 downturn, and it took just as long to recover from the Great Recession as the S&P 500 approach. But it took the longest to recover from the slump in 2020. In December, it finally raised its head above water. On the plus side, it created more revenue and dividends than either of the other options, and not by a small margin. During this time, it generated $694,000 in dividend income, which is just under $48,000 per year, or $3,965 per month. However, it did manage to maintain a significant lead over the other two techniques for people wanting to live only on dividends. It's a different question whether this is a net advantage for folks who aren't going to live solely on their dividends. For example, following the high-yield technique, you might have lived on roughly $61,500 per year over this time and still had at least $1 million in your nest egg by mid-2021. Using the S&P 500 technique, you could have lived on just over $68,000 per year and accomplished the same thing. There's the high-yield option, which will likely create the most dividend income, and thus let you cover your costs in retirement with less money overall, but it may sacrifice some returns in the form of share price gain in the process. Then there's the method of investing slowly but steadily in companies with a lengthy history of paying and increasing dividends. It may take a larger nest egg to fully cover your expenses with dividends income alone, but it may also be more stable during market turbulence while not giving up as much as those share price appreciation-based returns as the high-yield approach would. Finally, there's the standard index fund approach, where you aren't selecting the investments for any dividend-centric purpose per se, but are happy to accept whatever dividends are paid out along the way. If the goal is to retire purely on dividends income, this approach will likely require the largest overall nest egg of the three. Because this strategy is less reliable than dividend growth, you may have more opportunities to buy when the market is on sale. As always, this video is for educational purposes only and not a financial advice. Always do your own research and speak to a financial advisor. Thank you for watching and see you in the next one.